Welcome to ForexTV.com's New York Forex Market Buzz. It's Wednesday, August 26, 2009. I'm Julie Sinha. Earlier in trading, U.S. data, including durables and home sales, seemed to support the U.S. dollar as a safe haven choice. The greenback retraced some of the week's losses on the news, but there is a question remaining by many analysts. It is if fundamental reports are still providing an inverse correlation with the U.S. dollar and Japanese yen movement, or are we going in another direction? Today, U.S. durable good orders surged in July, but a gauge of business demand, non-defense capital goods, excluding aircraft, fell in the month. This is a sign for many investors and consumers that there are still some obstacles on their way to a recovery. Also out today, we had a jump in U.S. new home sales that was accompanied by dollar selling, but the dollar has shown itself to hold. Also in the U.S., President Obama said yesterday he's nominating Bernanke for a second term. This seemed to lift market sentiment overall. Let's talk to our expert and hear his views. Joining us via webcam to discuss this and price action is M3 Capital President John Netto. John, thanks for being with us.
Julie, it's great to be on the show. How's it going out in New York?
It's going well. We got a lot of traders talking about summer doldrums, but we're getting close to September. So just wanted to see your thoughts about how you think the U.S. dollar is performing. It seems to be holding, despite mixed news, it seems to be holding its place, but we see traders taking in and locking in these profits and other higher yielding currencies. What are your thoughts about major movement with the U.S. dollar right now?
I think that the underlying theme that you want to pay attention to with the U.S. dollar, and it goes even beyond the U.S. dollar, is what's happening with implied volatility levels with September, October, and November prices. We've seen that despite the consolidated trading range that we're in right now, we still see a lot of rich implied premiums. Looking at the S&P 500, even the 900, 925, 950 puts show a disproportionately higher amount of premium priced into them on the downside than do their corresponding upside numbers. I think that's a telling tale that people are at least anticipating a lot of volatility coming in the fall, and being that we're in a marketplace that has both a risk-averse and risk appetite dynamic at play, the equity complex obviously representing the risk appetite component, that when you see that kind of rich implied premium on the downside, it suggests that there's going to be some opportunity for this coming fall. So I think it's more than a question of just what's the dollar doing. It's a question of what is the market anticipating across the entire investment spectrum.
And when you talk about the investment spectrum, we heard a lot of talk about where the S&P is going to go, and that's a huge correlation factor or detail for a lot of FX traders. But sometimes, at this point in some recent sessions, we are seeing an unwinding of this inverse negative correlation between equities and how the U.S. dollar is moving, how Japanese yen is moving. They're both considered safe havens. Now, where do you see equities, particularly S&P, going in the fall? And even with the higher volatility, what kind of levels could we hit? What could this mean to the FX traders, major traders?
I think that the S&P can pull back to the 950 level, 940 level, even as short time as the next 4 or 5 weeks. I think when the sell down or when the pullback does happen, and ultimately rallies happen, pullbacks happen, it's part of the dynamic. It's going to happen pretty swift, and then from there, a lot of us will be kind of at that inflection point of, okay, we've just had this sharp pullback. It sure feels like a lot like 2008. And then from that point in time, we have to ascertain what the proper direction is and what the proper exposure levels are based on that. But I do think that the S&P is going to pull back. I think that the implied volatility levels may be a bit exaggerated in terms of like the kind of value you're getting for buying them that far out. I mean, it would take right now, a pretty substantial move down to come and hit S&P 900. And that in my mind would accompany a move in the euro down to the 137, 136 handle. We'd see a move in crude probably back to 63 or 64. I think that correlation, if we do get a pullback in equities, that correlation will creep back in again and yield itself.
And what do you think the story is, John, for commodities and commodity-linked currencies? We saw Aussie fall recently, and that also was after some movement in equities in Europe and in that session of trading. So what do you see for the story for commodity-linked currencies and the oil story? How could that play out, at least in the next few sessions and as we head into September?
I think commodities will probably precede the move down in equities. I think if you look at crude oil, you look at the Aussie dollar, you look at reformulated gasoline, heating oil, silver, copper, those guys are gonna take the first fall. is the financial component of there's still a lot of money on the sideline from the equity side that I think is going to offer more of a bid or more support juxtaposed to the commodity space. And so while I think we're going to get a pullback in equities, and while that will also it will be preceded by a pullback in commodities, the dynamic between those two and the one-for-one correlation or the day-to-day correlation may not be there, but ultimately both are vulnerable right now.
And John, you brought up a very good point, an interesting one. What about that money on the sidelines? Are we going to see a lot of that put into play? Do you think it's September, October, as volume across all markets picks up, and where will it go?
Well, while I don't control the coffers on the hundreds of billions of dollars that are purportedly waiting to be put to work, I can say that there are clearly mandates, a number of long-only funds, and so if there is a meaningful pullback, I'm pretty confident that over the course of the next 6 months that capital will find its way back into things as what appears to be economic news is not as is a little more sanguine than what it was a year ago at this time. It appears that obviously that the growth that the sell-off has at least stopped it on a lot of fronts, and as a result of that, we have Asia showing a lot of strength, which could potentially lead us out of this, or at least help buttress some of the economic weakness that we may see in the coming months or quarters here in the U.S. and Europe. And so I think with that perspective, the capital that does get redeployed won't just be U.S. based, but will probably invest itself in a basket of investment vehicles to take advantage of that.
Okay, John, thanks. I just thought I'd throw that question out there. Of course, I know if you knew where the hundreds of billions of dollars would go, you wouldn't be talking to us right now. But going forward, though, with the FX story, a lot of traders are talking about
Julie, I'd still be talking to you because I love this show.
Oh, John, nice response. We appreciate it. We love having you on. I also, another question for you is that the profit taking that we are seeing in FX, particularly in higher yielding currencies, some analysts are saying that this could turn into a more positive environment for the U.S. dollar later on. Do you see that happening, or do you see that we should just look at trades day by day and just see what happens?
Well, I think it's important that you don't put the dollar in just one large or ginormous set. I think the dollar is all about the currency that you're comparing it against: dollar versus emerging market, dollar versus Asia, dollar versus Europe. And within that context, there will always be dollar pairs that are trending up and dollar pairs that are trending down. And so the dollar in general, I think, will continue to strengthen against some of the countries that maybe don't recover as fast or don't quite put into place the financial safeguards that attracts the kind of foreign capital necessary to invest there. And then on the other hand, if it looks at the Fed as it's truly ahead of the curve and can raise rates and follows through with that and seems to have inflation controlled, the dollar may strengthen against some of its global counterparts.
And John, so where are the opportunities, do you think, for FX traders? We got a lot of as you mentioned before we in the show, a lot of spot traders, a lot of short-term traders, medium-term traders watching us. What advice do you have for them? Because you're right, it's not just about the U.S. dollar, definitely, sure. And you've got a lot of cross-pair traders, even minor traders. What are your thoughts about what we could look out for? What are some opportunities, at least in the next couple of days or even into next week? Where should we be looking at?
Sure. The last time you asked me this question, I was on this show 2 weeks ago, and I thought that we were going to stay in a range bound in a bull put spread on the euro by selling the 142 put and buying the 139 put for September would be the best way to play that. That's worked out rather nicely. The euro's still sitting near still sitting 142.30. So those 142 puts have definitely fallen off in value, while the 139 puts have fallen as well. But that's been a net profitable position. I think I'm going to go the other way now.